Erode Arts and Science College. I am Professor Vetrivel, Assistant Professor of Department of Banking and Finance. My subject is Bank Financial Management. Unit 1, Financial Management and Risk Management. Meaning and definition of financial management. First one, meaning of financial management. Financial management means planning, organizing, directing and controlling the overall financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to financial resources of the enterprise. Next, definition of financial management. According to Gutman and Dougal says that financial management is the activity concerned with planning, raising, controlling and administrating of funds used in the business. Scopes of financial management. There are three main scopes of financial management in this: financing decision, investment decision and dividend decision. First, I would tell about that financing decision. Financing decision, it's also managers make decisions pertaining to raising finance from long-term sources and short-term sources. For example, financial planning decision and capital structure decision. Then, investment decision. These type of investments have two types: long-term investments and short-term investment. Long-term investment decisions are investing in a building, land, acquiring new plants, machinery and replacing old ones. Short-term investment, these type of investment, investing of funds in the cash inventory and bank deposits. So these are all the types of long-term investment and short-term investments. And dividend decision. Dividend decisions to the portion of profits that will be distributed as dividend. Shareholders always demand a higher dividend while the management would want to return profit for business needs. So these are all the scopes of financial management. Importance of financial management. The various and multiple importance are having in financial management. First, it provides to guidance in financial planning, and it helps in investing an appropriate amounts of funds. It increases also organizational efficiency. It reduces delay production. It cut down financial costs. It ensures proper use of funds. It prepares guidance for earning maximum profits with minimum cost. It increases shareholders' wealth. It can control the financial aspects of the business. And it makes the employees aware of saving funds. So these are all the importance of financial management. Objectives of financial management: profit maximization, wealth maximization, proper utilization of finance, survival of company, proper coordination and creating goodwill. Now I explain to profit maximization. What is profit? It is main aim of any kind of economic activity is earning profit. Profit is the measuring technique used to understand the business efficiency of the concern. Then, wealth maximization. Wealth maximization means to earn maximum wealth for the shareholders. So, the finance manager tries to give a maximum dividend to the shareholders. Proper utilization of finance. The finance manager must make optimum utilization of finance and using the finance profitable. survival of the company. The finance manager must be very careful while making financial decisions. One wrong decision can make the company sick and it will close down. Proper coordination. Financial management must try to have proper coordination between the finance department and other departments of the company. Creating goodwill. Goodwill must improve the image and reputation of the company. It is also helps the company to survive in the short term and success in the long term. Differences between liquidity and profitability. Basics are meaning, ability, time and ratios. Meaning of liquidity. Liquidity is the degree to which a security can be quickly purchased, otherwise sold in the market at a price reflecting its current value. Meaning of profitability. Profitability is the degree to which a business otherwise activity is profits, otherwise profits gain. Ability of liquidity. Liquidity is the ability of a company to convert assets into cash, but profitability is the ability of a company to generate profits. Time. Liquidity is less important in short time, but profitability is more important in long time. Ratios. Key ratios are current ratio and quick ratio, but profitability using ratios include gross profit margin, OP margin and net profit margin. Changing scenario financial management in India. So, first, interest rates. Interest rates are controlled by Reserve Bank of India and other commercial banks. Rates are affected from Reserve Bank of India's action. Second, value of shares. Value of shares now can be determined at premium, otherwise discount freely. Third, change scenario in merge. As good finance manager should keep eye on who's take over which company. So these are all the very important for changing scenario financial management in India. Risk management and risk identification in banking business. Risk identification is the process of taking stock of an organization risk and vulnerabilities and raising awareness of these risks in the organization. So various risks in having the risk management in banking business. Economic risk, compliance risk, security and fraud risk, financial risk, reputation risk, operational risk and competition, otherwise comport risk. So these are all the risk identification of banking business sector. Banking risk definition. Banking risk is defined in financial terms as the chance that an outcome, otherwise investment's actual gains, will differ from an expected outcome, otherwise return. Risk includes the possibility of losing some or all of an original investment. Types of banking risk. The various types of risk having in the banking sector. Systematic risk, unsystematic risk, credit of default risk, market risk, operational risk. Systematic risk. Systematic risk is also known as undiversifiable risk, otherwise volatility risk. It is affects the overall market and not just a stock or industry in particular. Unsystematic risk. It is the risk that affects a very small number of assets. So, this type of risk refers to the uncertainty inherent to a company, otherwise industry investment in particular. Credit of default risk. It is the risk in which a borrower is unable to pay the interest, otherwise principal on its debt obligations. Market risk. The Basel Committee on Banking Supervision defines market risk as to the risk of losses in on-balance, otherwise off-balance sheet positions that arises from movement in market prices. Operational risk. The Basel Committee on Banking Supervision defines operational risk as to the risk of loss resulting from inadequate, otherwise failed internal processes and people and systems, otherwise external events also. Next, I would explain to credit risk. Meaning, credit risk is the possibility of a loss resulting from a borrower failure to repay a loan, otherwise meet contractual obligations. Credit risk management framework. As in the case of market risk management, credit risk management also involves finding answer to 4 key questions. First one, what are the risks? Then, which, when and how much risk to accept that results in improving bottom line? How can we monitor and control credit risk? And the last one is, can we reduce the risk, and if so, then how? Management processes are defined essentially to answer these questions. Accordingly, credit risk management processes are subdivided into following 4 parts. First one, what are the risks? It is the question, but risk that identify to credit risk identification. Then credit risk measurement, which, when and how much risk to accept that results in improving bottom line, so that answer credit risk measurement. Then credit risk monitoring and control. Then last one, credit risk mitigation. Credit risk control and monitoring. First one, identification of portfolio credit weakness in advance, moves towards credit portfolio value at risk models, and final one, evaluate rating wise distribution in various industries and set corresponding exposure limits to contain concentration risk. Thank you.